Hello guys, welcome back to my channel. So today I'm going to discuss about a very important topic. It's hedging. There are variety of hedging that you can do, and you can, for example, you can have some stocks in your holding, like delivery holdings, and you want to hedge against that. Okay, there are many kind of hedging. So that topic is kind of out of scope for this particular video. I'm going to focus only on basically like derivatives, those who trade in derivatives, and let's assume they are doing like some swing trading. Okay, so it's not about hedging your cash portfolio, it's about hedging your derivatives positions that you carry forward for maybe uh, 3 days, 4 days, or 1 week, or till the expiry. This kind of swing trading that I'm talking about, and how you can hedge your positions. So this is best suited for those who do swing trading in derivatives and they trade naked futures. Okay, and how they can actually make use of hedging, and is it necessary for them, or is it just a waste of money, or because you're going to compromise on your profits and everything. So before going deep into those topics, okay, as I promised in my last video, I'm going to pose a simple question for you here in my every video. So you can see this chart, you can pause this video and just observe this chart and identify whether it is in an uptrend or in a downtrend. Okay, so I'm going to reveal the answer later on during this video. So this is your question. Right, cool. Now moving on. See, first of all, there are, if you look at some books about hedging and everything, there is a lot of details covered and all those things. I don't want to go into all those details. What I want to focus on is how you can practically apply some of the hedging concepts in your trading, and that's why I'm specifically saying I'm not going to touch upon cash portfolio hedging. Okay, let's save that for other video later on. But for now, I'm going to focus only on, see, what kind of person or trader are you. You are a derivatives trader. You trade in futures, and then you carry it forward for maybe 5 days, 10 days, or even 1 day maybe. Okay, anything overnight carrying forward. Okay, it could be 1 day, 2 days, 3 days, 1 week, 3 weeks. So essentially you're a swing trader and you want to hold your derivatives positions overnight or weekend and everything. Okay, so now what you have to do here is, for example, why do you want to hedge? Basically, hedge is basically you want to try to mitigate your risk. That's what the hedge is basically, right? You want to mitigate the risk. Now, to mitigate the risk, you have to understand what is the risk actually. What kind of risk are you taking? For instance, there are two types of risk that you are taking. One is the directional risk. Okay, the other one is overnight risk. Okay, so overnight risk is basically the market is not open and you don't know what prices might happen overnight and how it may open the next day. So that's the overnight risk. It could be weekend as well, or long holidays, or anything basically when you're not in front of the screen to trade. That's it. That's I call as overnight risk. The other one is the directional risk. So let's go one by one. What is directional risk? Let me just show you here. Go here and type. Okay, one is directional risk. Okay, that's what we talked about. And the other one is overnight risk. Okay, so these are the two risks that you are having. Okay, now which one is better? Which one should you go for? If you have taken a position, which one should you opt for? Many people who trade in futures, either they are confused, they don't know anything about hedging, and they're just not bothered about hedging their positions. One, the other, some other set of people, they know about hedging, but they are not hedging it properly. Okay, why I'm saying that is, they take, suppose for instance they take a position in futures, and then by the end of the day they will just take one call option, or if they have bought the futures, so they will just buy put options, kind of a thing, at the money put of the options, something like that, put options, and then they think they are hedging, and by the end of the trade they will see that they have compromised so much on their profits. Okay, it's just because there'll be time decay in options and everything, and you know basically the price might go against it and they might lose in premium as well. So there is a risk of losing premium as well as time decay when you are buying options, and that's the reason you're like compromising on your profits. Yeah, some people say it's a trade-off and it's kind of insurance, and you have to accept that as a transactional cost. But one thing is very important here: transaction cost, fine, but this is something that you are losing money or losing on your profits just because you don't have the right knowledge about hedging. So that's what I'm going to touch upon in this particular video. So as I discussed, first is directional risk, second one is overnight risk. So let me explain to you what a directional risk is. For instance, you have taken a position in, say, Coal India. Okay, you have taken a position in Coal India. You are long in the sense you have bought Coal India, and you are expecting the target to be reached in probably 5 days, 5 trading days. So obviously you have to carry forward overnight. Okay, so that's one thing. So in this very particular example, we know we are taking Coal India as an example, and the person is going long in this Coal India, and he is expecting the target to be hit in the next 5 to 6 trading days. Now, two types of hedging can be done. Okay, one is directional hedging. So for instance, he is long in Coal India, and if price goes down, okay, it could be overnight or during the trading time itself, it could go down. So that is a directional risk, because this trader is thinking the Coal India price is going to go high, but instead the price is coming down during the trading hours or gap down the next trading day. So that is a directional risk. Okay, because the direction of the price is going against the trader's favor. I hope you're getting it all right. So that is it about. So if the price goes in favor of his direction, which is like prices go higher, it's kind of going in favor of the trader's position. If it goes against, it's like a losing position. So that's the directional risk. And now overnight risk I have explained to you already. So overnight risk is basically when trading doesn't happen, and you just don't know where the price might open the next day. So that's overnight risk. So if it gaps up and you are long in that position, in this case Coal India, the trader is long, he has bought Coal India futures, and the price has gapped up the next day, then fantastic, it's all superb. He's making overnight profits there, which is great. In case price drops down or gaps down the next opening day, then this trader is going to lose money. So we don't know how much he's going to lose. It depends on where the price opens the next day. So that is an overnight risk. So you clearly know now the directional risk and the overnight risk. So which one is better, and which one you should be opting for? Before that, I will tell you what I personally do. Okay, I have shared with you some of the live trades like in SBI, in PEL, in Maruti. So I have already shared those videos with you, how I took positions. They were all long positions. I bought those futures, and let me tell you how actually I hedge my positions. Okay, say for instance, let me go with PEL. Okay, PEL, I was long in this futures, okay, and I carried it forward for nearly 4 or 5 days. I don't remember exactly. I think I had to carry it for 4 or 5 days. So obviously they were both, when I took the position, there was this directional risk, right, as well as the overnight risk, because I was planning to hold it for 4 to 5 days. So I was exposed to both kind of risks. Now what I personally do is, for the directional risk, okay, for the directional risk, I have my stop loss placed, right? And you might be saying, oh, that's simple, even I place stop losses, it's nothing special, everything and all those. That's right. So that's what you should be doing. For the directional risk, you should have a stop loss. If it hits your stop loss, then you're out of that trade. Okay, so this is well and good as long as you are in front of the screen and trading is still going on. Okay, but it's not going to protect you from overnight risk, correct? So you have the stop loss when trading during the trading hours, I would say. But what about the overnight risk? There won't be any trading, and this stop loss, it say for instance, if your stop loss, let's say, okay, let me just take this. Okay, let's say this is your entry price and you are going long, and this is your stop loss. So what if the market gaps down somewhere here the next day, right? So you are exposed to overnight risk, and your stop loss is not going to cover that. It might cover or might not cover. If it gaps down below your stop loss, then it's not going to cover you, right? So you will be completely exposed to overnight risk in that situation, right? So now how do we do that then? What I do is, for directional risk, I have stop loss. So when I'm in front of the computer and during the trading hours, I know my stop loss and I'll be monitoring the price. If it hits my stop loss, or I would have already placed my stop loss order and that would have been hit. So that I'm taking care of. To take care of the overnight risk, remember, I'm going to buy put options. And even this might sound very familiar to you. Okay, yeah, what's so special? Because you already said about losing profits when you're buying put options, because that's going to decay. There'll be time decay and also premium decay as well. Yes. So what I personally do is around 320, between 320 and 330, before it closes, right? At that time, for example, PEL was trading around around 320. Okay, before 10 minutes before close, it was trading around 1750 or something. Okay. Now, what most of the traders would do is to they would take to cover their overnight risk, they would normally purchase 1750 put, right? 1750 put. So just to be to cover that overnight risk. But what I'm trying to do here is, let's say my stop loss was 1600. Okay, and my stop loss I have already placed here in this particular example. Let's say my stop loss was 1600. Okay, so what I normally do is I take 1600 put. Okay, not 1750 put, which is at the money. I'm taking completely out of the money put option. Why? Because if my assessment is right, then I shouldn't be facing the directional risk. It shouldn't hit my stop loss. That's the main assumption when you're taking the trade, right? That it's not going to hit your stop loss and you're going to hit the target. So if your assessment is right and the market sentiment is good and the price goes in your favor, then there'll be no directional risk. And that's the reason I don't want to compromise on profits just because there is some overnight risk. But at the same time, I want to protect my position there. So that's why I'm taking out of the money put options. Okay, it could be even 1500 put if it's got liquidity. To give you a better idea, let me give you an example of SBI, what I did in SBI. Okay, I was long in SBI. Okay, that means I bought futures in SBI, and I think it was around 245, maybe 245, I guess, and I was expecting to carry it forward for next, and again, 4 to 5 days. So at the end of the day, what I used to do was, when it was trading at 245, I used to buy 230 put option. You see, 15 rupees gap. It's completely out of the money option. Okay, so why do I do that? Because all I'm thinking of is, if my assessment is right, it has to go in my favor. So if it doesn't go in my favor, then it's going to hit my stop loss. That's okay, it happens, because that's part and parcel of trading. But I'm not going to, you know, do something to protect my directional risk. I don't want to do that. I just have stop loss placed. So for the overnight risk, I want to spend as minimum as possible, because all I'm thinking is it's not going to do anything of that sort if my assessment is right, and it just have to, you know, be reasonably in my favor or slightly out of my favor. That's all, not like drastic out of my favor. So that's the reason I'm going to buy 230 put option, just to be on a safer side. I'm not expecting SPI to open at 230 the next day, but in case if that happens, I want to be protected. I don't want to lose more than 15 rupees, okay, per share, or in this lot size it would be much higher, 1500 I think SBI. So I don't want to lose more than that much money. At the same time, I'm protecting myself as well, so because I don't want to lose too much. So all I'm losing is probably very, you know, few paisas here and there, because if it opens at the same price or slightly higher as well, then this might just lose, you know, 10 paise or 20 paise, because it's completely out of the money. It's not going to lose everything in one single night like that, unless it's very close to the expiry. That's the whole idea, guys. So I have explained to you about the directional risk, overnight risk, and how I would do. Okay, for directional risk I have stop loss placement. For overnight risk, I'm buying out of the money put options, because I'm not really scared about price coming down and hitting my stop loss. Okay, it might happen that I'm not protecting that. I don't want to, you know, if price comes down from where I entered, and I would at least make some money out of my put options. No, that's not the idea. My idea is to gain big or lose small. So I'm have confidence in my assessment, and if it turns out to be good, then that's fine. So, and you know what, that's how you be a profitable trader. So out of 10 trades you take, if you're profitable in, like, say 6-7 trades, that's fantastic. You will have a very good profitable traders equation. That's what I'm focusing on. 1, 2 or 3 times if you lose, or if you know, lose slightly, or if you hit your trailing stop loss, that's fine. But apart from that, I'm not going to hedge to, you know, mitigate my directional risk. My directional risk, stop loss placement will do that for me. I have my stop loss that is going to take care of my directional risk. So now let's dig into some of the charts. Okay, I'm going to dig into some of the charts here. Let's go here, like say Coal India for example. I just opened this one to show you this. See, this is like a very good looking chart, and you know, it might tempt you to go long somewhere here, right? So in case if you are long and you are expecting these kind of prices here, but all of a sudden it opened gap down here, you see. So I'm just going to show you what was the gap. See, the closing price was this, and the next day opening price was nearly 5.25% down. So that's the kind of risk I want to get covered. Okay, it's a big 5.25% down. No, don't know what news flowed in overnight or something, I don't know. And I don't think it was a weekend as well. Yeah, it wasn't a weekend, it was just a normal weekday, and it lost so much. And this happens, I mean, if your direction is correct, and most of the times it will be in your favor. It usually gaps up if you're long, it gaps down if you're short. So that's what normally happens. But sometimes you know, these things can happen, and you want to be protected, because whatever the gains you have made from, like say 20-25 trades, you shouldn't be losing in just one trade like that. Okay, so that's why you want to stay protected. You have to protect your profits. Another chart that I noticed was in I think it's Hindalco. I mean, I didn't get much time to look at many of the stocks as such. I think it was this one here. If you focus here, it closed here, and the next day it opened. Okay, let me just check. Closing there, opening there. It was down by nearly 3.5% down. And same thing happened here as well. Like there was some gap downs. And you have to understand the behavior of the stock as well. Does it normally do gaps up and gaps down, these kind of things, quite frequently or not, and all those things. So especially if it does, then you must have this overnight risk mitigated using hedging. And as I said, to summarize what I have said told now, there are two types of risk that you will be having when you take a position in derivatives, in futures, long or short. One is the directional risk, the other one is the overnight risk. For directional risk, you are right in front of the system and you know what is happening. You can set alerts as well, and you can also place the stop loss order as well. So stop loss is going to take care of your directional risk, and you must have that stop loss in place. Okay, before taking the trade, you should know what your stop loss is. So that's going to take care of your directional risk. For the overnight risk, it's the out of the money put option or call option. If you are long in futures, you're going to go for out of the money put options, okay, and if you're short, you are going to go for out of the money call options. So the premium will be very less, and if the market just opens flat the next day, you're not going to lose too much. Just assume that this is like a cheap insurance that you're buying, which is very important and effective as well. Don't think that because it's out of the money and it's cheap, it's not going to cover much. It is going to cover much, except the directional risk. These kind of unforeseen news or something situations come up overnight, it's going to cover against all those things. So I mean, obviously you want to buy insurance and you don't want to exercise that insurance, right? So nobody wants to exercise the insurance. You have your health insurance, medical insurance, accidental insurance, and all those things. You want to be protected, but it doesn't mean that because you're paying that, you don't want to exercise that. You know what I mean, right? So it's okay, and you actually wish that you don't have to exercise that. That's exactly what this is all about. You are just protecting yourself from really unforeseen things that can happen overnight. I hope you got the gist of hedging. This is what I do in terms of hedging. And coming back to our question, so this was a question I asked you, to identify what trend it is in. Okay, so if you had answered downtrend, then unfortunately you are wrong. If you have answered uptrend, then you are right. Why? Let's give you a quick view of that. Okay, see here, 1 second, it was clearly going up. Right, it was clearly in an uptrend, and unless this level is broken, right, it's not going to change its trend. It is still in an uptrend. It can continue its trend from any point, from here, from here, from here, from here, anytime, unless it breaks this and starts trading down. Then we can say the uptrend has ended. Okay, so I hope you got that idea there. So that's what happened here, and it continued its uptrend. Okay, I hope you enjoyed this video, guys. I'm going to post some of these videos in future as well. So to keep me motivated, please do like and share this video, and also subscribe if you haven't done yet. Join my free Telegram channel to know some real-time updates. The details are in the description box about the free Telegram channel, and share with your friends so that it can be helpful for them as well, and it keeps me motivated as well. See you guys, bye.